Hello, guys. Everybody's wondering what happened with a new tax law that passed, right? It's
Yes.
been coming, going on, and back and forth, and so much disinformation and misinformation. Let's see what really happened.
Yes. So what actually passed? I mean, we had this bill. It was the one big beautiful bill. If you like it,
But some people didn't
or
like
if you
it.
don't like it, then it's the ugly small bill. And if you don't like that, then it's the reconciliation bill. That's the technical term for it.
But that word may be too big for some
Yeah,
people,
so-
so we'll call it the new tax bill.
Exactly. A new tax bill. This is what it is. So what does it do? All right. So and specifically, what are the provisions that affect retirees? Especially retirees that have been paying a lot of taxes and would like to be paying less taxes. So we're not really going to talk about how it affects the Medicaid stuff, which has been talked about a lot. Mostly, what is it affecting retirees? So first of all, the big win for retirees out of this is the current brackets are remaining the same. We were scheduled to expire these brackets and have a massive increase in taxes, but that is not happening. We are going to stay the same.
So let me restate that. It's a big win because you're not going to get a tax increase, and you're going to have space in your brackets to continue the Roth conversions and other strategies that you otherwise was going away at the end of this year.
Now, how long is it extended for? It's
Permanently.
Permanent. Now, what does permanent mean?
Just until the next person gets elected.
Yeah, so permanent in Washington, nothing's really permanent, especially with taxes, but at least for the next few years, it looks like we're not going to have an increase in the bracket, so that's useful.
See, the last time Trump passed these tax breaks, it was a 10-year tax law.
Right.
So that expired automatically in 10 years, which was expiring at the end of this year. This one has no expiration date, so it's permanent until somebody changes it.
And then we have the standard deductions. They increased a little bit to now $31,500 for a married couple. Now, both of these and all of these provisions pretty much that we're going to be showing you, they are retroactive to January 1st, 2025. So even though they passed it in the middle of the year, it affects all of your income for this year. And the Congress normally does that. When there's a good tax provision, it affects you retroactively. If there's a bad one that's going to be an increase in taxes, usually that's delayed a year.
But only to the beginning of this year, not for last year.
Yes, unfortunately, you can't go back to 2024, but this is what it is.
And most of these this information is from married filing jointly. We can certainly help people that are single as well, but limited time and space. We're just going to focus on married filing jointly here.
And for single, it's about half of all these numbers. And then you still have the deduction of $3,200 for being over 65, but there is a new bonus deduction if you're over 65. It's $6,000 per person. And this is the really cool part, is whether or not you're itemizing. But unfortunately, this one does expire in 3 years. So 25, 26, and 27 expires in 28.
And you're limited to $150,000 of married.
MAGA, modified adjusted gross income.
Right.
No, that's not MAGA. That's Maggie or Magi. Married. Now you got me saying married. Modified adjusted gross income, which is adjusted gross income plus untaxable Social Security and a couple other things, but very similar to AGI. And once you're above that threshold, you get less of this deduction. Once you're above 250, you get none of this bonus deduction. But it can be very useful for those of you who are spending less than $150,000. Maybe you have a lot more, but some of it's already Roth, but you can still take this deduction for the next 3 years. Now, if you combine all these things together, if you're married over 65, you potentially could have a $46,000 standard deduction.
That's pretty large.
Yeah, it's really big. And there's a lot of cool stuff you can do with that. We'll be talking to all of our clients over the next several weeks and months on how to maximize what you could do with this. And then this is another thing, because a lot of people were complaining that because the standard deductions are so big, and that's a good thing, it means you don't have to spend the time to itemize, or you don't have to come up with all these itemized deductions, but it kind of discouraged charitable giving, because especially if you weren't giving that much, tens of thousands of dollars to charity, you weren't being incentivized to give to charity. So now you can deduct up to $1,000 per person, so $2,000 for a married couple, even if you're taking the standard deduction. So that's cool. Right. And then the estate tax threshold is actually increased again. It was $14 million, now it's $15 million for anybody who passes away in 2025.
And it's permanent, so it's not changing every year. It's 15,000 period.
15 million.
15 million, so 15 million period until they change it.
And then we have an increase to the SALT deduction. This is one that was a huge, widely talked about provision, and it especially affects those who live in higher tax states, such as, say, California, Maryland, New York, maybe Illinois. There's a number of states that are higher tax, and especially if you're paying a lot of property tax or you have multiple properties, even in a lower tax state, if you have more than one property, a lot of times you are running into this limit. You could not deduct on your federal return more than $10,000 of state and local taxes. That's what SALT stands for, state and local taxes. Now it's $40,000. It's $40,000 total for a married couple. And that is, again, it's only for itemized, but if you actually have that much to deduct, then that'll be more than the standard deduction would be anyway. And you could still potentially take that bonus deduction of $6,000 per person.
And if you're single, what's the SALT deduction?
Single is also $40,000.
Still $40,000. So whether you're single or married, you still get that $40,000 SALT deduction.
Now we also have a new quirky one. It's a $10,000 deduction for car loan interest. Now, the car must be assembled in the United States, and it must be purchased sometime from 2025 through 2028. So it's only a 3-year thing again. So a couple of these things are new stuff that's only for 3 years, and we'll see if they increase or extend those later. And now, here's a cool one. You can also deduct your mortgage insurance again, the PMI. So
we're not talking about the mortgage interest, talk about the insurance on that. If you didn't put much money down, then you have to have PMI, and that is now tax deductible, which it wasn't before.
And we talk a lot with our clients of, even if you're retired, having a mortgage is usually a really good move, especially if you have the money to pay cash. You probably shouldn't. Right. Because you could keep that money accessible in an emergency. It could hopefully earn interest that's similar or better than what you're earning or you're paying on the mortgage. But so being able to put less down on the house and still deduct the mortgage insurance, that could be very useful for a lot of people.
And with the PMI deduction, that makes it even more favorable for those that just want to keep their money and use somebody else's money to purchase stuff.
Exactly. Because generally, anytime you have less than 20% down, you have to buy a PMI. And previously, there was no incentive at all to do that. Now, there is at least some incentive. The $750,000 cap on mortgage balances for the interest deduction, that remains the same, so that's not changing.
So this actually, PMI is really for lower income people that don't have money to put down and still want to get in the house. So this is a really good deduction for them. And so there's a lot of good things in this tax bill. We're only going over a few things that really affect retirees, but there's a lot of good things in there.
All right, so make an appointment with us. Click the link in the description or go to our website, riskfeestaxes.com, to make your appointment. Again, that's riskfeestaxes.com. We look forward to talking to you soon.